Good evening, everyone. On behalf of Dadari CP Study Circle, I welcome you all to the today's seminar on practical issues faced in Form GST 9 and 9C. We are aware that now CS certification is not required for 9C, but still our role is there while filing 9 and 9C. So before filing 9 and 9C for 2021, we might be having some questions or issues. So we can resolve it with today's learned speaker Mitesh bhai. So before Mitesh bhai starts, I request Parin to play ICI motto.
Thank you, Rahul.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, Parin. Now I request Akash Gogri to introduce today's speaker. Akash bhai.
Thank you, Rahul bhai. It gives me immense pleasure to introduce our today's speaker, CA Mitesh Doshi. CA Mitesh Doshi is a qualified chartered accountant with 8 years of indirect tax experience, including 6 years of post-qualification experience. He has a vast array of work profile, including compliance, advisory, audit, and litigation. He has assisted. He has 4 years of experience under renowned professional SS Gupta in the indirect taxation field. He has also headed the GST audit team of 20 plus CAs who are responsible for streamlining a lot of GST processes. He has assisted various corporates and MNCs during the transition from erstwhile tax regimes to GST. He is an active speaker in Connect Easy and Global Chamber of Professionals. With this brief introduction, we welcome CA Mitesh Doshi and thank him for giving us his valuable time today and sharing his views.
Thank you, Akash. Before Mitesh bhai starts, I request Jinal Savla to present e-certificate to today's speaker.
Thank you, Rahul. It gives me immense pleasure to present this e-certificate to today's learned speaker. Mitesh bhai, this is for you.
Thank you.
Yeah, over to you.
Yeah, Mitesh bhai. Thank you.
Yes.
You can start.
Yes. Thank you, Rahul bhai. Thank you, Parin. Thank you, Jinal. First of all, I'd like to thank Dadari CP Study Circle for inviting me on this platform, and I'm appreciating that still after almost 3 years of GSTR 99C in the 4th year also, Rahul bhai and the study circle feels that there is a deliberation still required before starting the audit, which is no more audit though, but I would be terming it as an audit because ultimately we are going to work like we used to work, except the certification part is not required, as we all know that. So thank you first of all for allowing me to put my deliberation. without wasting time, since 99C, I would also like to run through. Now, I won't be going in detail, friends, with regard to the each table, which consists of table 4, 5, 6 of 9 and 9C. So I would be just running through them so that I know it's been long actually, and we have been doing many income tax audits, and there were a season of other audits. So there is a time that we need a revision, quick revision. So that would be a revision basically from my side, which would be there. So not going in detail. In case Rahul bhai or Parim bhai, in case I'm going fast, do let me know. So with this, I would like to start my presentation, which I've prepared for today for you all. Uh, So what would be the coverage today? I have briefly mentioned out here. So basically, I would be covering the general points that are required for 99C with regard to filing of financial year 2021's 99C, not otherwise. So the points would be specifically for those. Uh, Thereafter, I'll be making your run through GSTR 9 and 9C in a quick revision manner. Thereafter, I'll be highlighting few things wherein there are divergent views over the period of 3 years and even in the fourth year. So it's presumed that many people might have already finished 9 and 9C since there was no audit required. However, since income tax audit and state audit due date was extended, and till now we are required to attach the financial statements, audited financial statements, many people could not complete even though they were ready with the GST 9 and 9C. So after that, we'll be discussing on the case studies, which I feel these are the general issues that have been faced by everyone in the past years and will be faced by in the current year as well. Thereafter, it would be more of a query discussion session because it is actually a practical topic. It is like you cannot anticipate all queries. As a speaker, I try to anticipate every queries which when I have not faced practically. So I can deliberate on that, but there would be definitely few queries which I also might not have thought of. So a discussion round with the participants, wherein people will be unmuting themselves, I believe so, with Parinbhai's permission, and thereafter explaining the queries, and I'll be addressing those. So that would be a half an hour full-fledged session. So with this, I'll just take you to the general points of financial year 2020 that has to be kept in mind. First of all, we know section 35.5, which is to cover GST audit, has been omitted completely. And so it has been clarified that from financial year 2021, there's no requirement of CS certification. So GSTR 9 and 9C, that is the reconciliation statement. Now the onus is on the assessee, the taxpayer. He has to file it. Though he would require our assistance, and we know at back of the mind that we are going to file it ourselves only. So with this, there was a confusion with regard to the limit. Now, to just clarify for those who are yet to understand that they are waiting for the limit of 5 crore every year, whether we are supposed to do 9C or not, my turnover is 3 crore, 4 crore. So this 5 crore limit has been set in the rule itself now with effect from 37 2021. Previously, it was always clarified or notified that for 17, 18, 18, 19, 19, 20, you're not supposed to do audit if your aggregate turnover is less than 5 crore. But now they have incorporated this in rule. So from financial 2021, by default, the limit is set to 5 crores for filing GSTR 9C. Now, as I have already said, audited financial statements are yet to be uploaded, even though we are not supposed to audit. But that is, they have kept it because ultimately, what is a reconciliation statement? What is GSTR 9C? In the service tax regime, people are still receiving notice of service tax. People were showing different turnover in service tax returns and different turnover in income tax or other statutory audits. So there was a need basically. This is what they have learned over the period of years that this is creating problem. Therefore, they have made this as a reconciliation statement. It was already there in VAT audit. We used to do fill form 704. So this is not new for those, but the ones who were showing different turnovers in service tax era, the professionals. So ideally, even we were included into that. So for those, basically 9C is a must basically so that department can have a catch that why are there variances between the turnover as per GST and turnover as per income tax return or audited financial statements ideally. So this is basically a RICO, which otherwise the officer would presume to be a taxable service. We have received show cause notices directly stating that the turnover in the audited financial or income tax returns is say 15 crores. However, you have shown in ST3 only 12 crores. So please pay service tax on the difference 3 crore. So in spite of receiving directly a show cause notice, we have given a RICO wherein they would analyze and thereafter ask the specific queries. At least this is what we expect. Though with time they will also learn and ask the specific queries rather than asking repetitive queries. So these are general points basically. So what is the limit? Basically, when is GST 9 or 9C supposed to be filed for financial year 2021? So for 2021, if your turnover, aggregate turnover, we know aggregate turnover. Now GST is almost 4 to 5 years old. So we know what is aggregate turnover because we need that for registration purpose as well. So we know that aggregate turnover is a pan-India turnover. So I won't be deliberating on that topic. So if your aggregate turnover is less than 2 crore, you are not required to file GSTR 9. That has been exempted. People have been, taxpayers have been exempted to file GSTR 9 by notification 31 by 2021. 9C is not required to file if it is less than 5 crore. So if it is between 2 to 5 crore, then GSTR 9 is required to be filed and GSTR 9C is not required to file. If it is above 5 crores, both GSTR 9 and 9C is to be filed. Now, for subsequent years, for financial year 21-22, we know that 5 crore limit has been set in the rule itself now. So this is not going to be changed. Now, this 2 crore limit is not there ideally for GSTR 9. GSTR 9, every registered taxpayer except for few persons like ISG, a person who are deducting TDS, TCS, they are not required to file. Every registered person is required to be filed. They are specifically exempted for financial year 2021. So we are not sure whether this would continue in subsequent years as well. Ideally, we believe so because those are small taxpayers and we should not burden them by unnecessarily asking them to fill more data to be compliant. However, future will tell us whether this is going to continue or not. So extended due date, what is the extended due date? I am sure everyone knows that, and that is why since income tax audit is almost over now, and now since GST audit is going to come, so it is GST audit season, though not audit, I already said. So that is why this session is being kept so that everyone gets through a revision. So I'll just make your run through Form GST 9 and 9C. I know everyone feels that they have already gone through because they have already filed thrice till now. So I'll just take you all to so that I and you all be on the same page. So first is disclosure of outward supplies. I'll be breaking it in the outward supplies part and the ITC part. So first we'll be discussing deliberately on the outward supplies part, the GST 9, 9C aspect, and the practical case studies and issues, what you're facing from the sales perspective, supplies perspective. Thereafter, we will be jumping on ITC part. So first is disclosure of outward supplies. Now we know there are two parts, transactions or supplies on which GST is payable or paid and supplies on which GST is not payable at all. So what are the relevant tables in GSTR 9? Table 4, wherein we have to disclose or taxable supplies. Table 5, wherein other than the taxable supplies are to be disclosed. Table 9 is ultimately the tax payable and the tax paid. The different, the computation, ideally we can say the liability that has been disclosed by us and what has actually been paid by us through 3B. Then table 10 and 11. I'll be going with this ahead. So this is table 4. First is there are different bifurcations. Though the turnover, the income of a taxpayer of an assessee is to be broken up into B2B, B2C, exports, SEZs. We know there are different transactions. There are deemed exports. So all those transactions have to be shown separately, ideally. So we need to have a tagging in the system itself. Now everyone knows whether this is a SEZ. Everyone has understood over the period of 3 years that SEZ has different meaning altogether and has a different disclosure. So people have started marking up or creating a customer master in such a way that they get the report also in such a way while filing GSTR 1 and 3B. So I'll just run through. In table 4, we need to give the taxable supplies basically, which is bifurcated into B2C, B2B, export on payment of tax. Now we know export can be done on payment of tax and without payment of tax under LUT. So only those transactions or those exports or those zero rated supplies, which ideally covers export also, and SEZ is covered in 4D. So those two on which GST is paid, only that is to be disclosed here. Thereafter comes deemed exports. Now people get confused over deemed exports. I'll try and highlight this deemed export example. I'll cover it separately and give you an example of what is deemed exports. Now 4F is basically advances. Now everyone knows that advances pe GST to abhi lagta hi nahi hai, but people still don't know that it is still applicable on the service portion. So if a CA, if we professionals receive an advance from the client, which we know generally we don't receive, we even receive it after 6 months or 1 year. But I'm just giving an example. So in case we receive an advance, so in that case we are supposed to pay GST on that advance, because the time of supply of that is at the time of receipt of advance. So that has to be disclosed out here, even though invoice is issued in the next month or in the subsequent period. So we have to keep a separate register. Ideally, it is also required to maintain a separate register as per the section 35 documents and records, wherein we give a details of the advances that have been received during the year, advances that have been adjusted during the year. So this is 4F. Thereafter 4G, it covers all those transactions on which GST is payable or paid under reverse charge mechanism. Reverse charge mechanism, we say ki everything is covered here. RCM on selective goods, we pay on purchase of selective goods also, if it is from unregistered persons, or on say we dry cashews or dry shells, those are there. Thereafter, in construction industry, even if the persons are registered, there is mandatory RCM, or even if they are unregistered, there is a mandatory RCM. So now we know section 9 subsection 3 and 9 subsection 4. There are two provisions which cover the RCM basically. One is wherein mandatory list of services or goods have been given on which RCM is payable, irrespective of the supplier, whether he is registered or unregistered. And one is where the person is unregistered. So now we know for the period 1st July 2017 till 13th October, every purchase from an unregistered person was triggering the RCM liability, but that has been exempted as of now, and only the construction, to the best I remember, is as of now covered in such this thing URD to RD RCM. So those all transactions, even import of services, are to be covered here. So basically, this is the supply perspective, but this only 4G is the part wherein we have to disclose liability on which we have paid GST. Thereafter, there are credit notes, debit notes. Now we know 9 and 9C, the form is actually a complicated one, and it is a very time consuming one. But however, we have been given very relief in 17, 18, 18, 19, 19, 20 and 2021 as well. Now we don't know whether those reliefs or exemptions or disclosure exemptions, to be specific, whether those will be continued in future or the form itself would be changed. We don't know anything. We don't know the future of GST 9 and 9C. But as of now, we know that there is relaxation, and I believe to an extent the form is going to be changed from next year onwards. So credit notes and debit notes with regard to B2B supplies, SEZ supplies, has to be disclosed in 4I, 4J. Similarly, amendments, I have disclosed wrongly. I have instead of 1 lakh, I have disclosed it at 10 lakh. So I have paid GST on that 10 lakh. So I have amended it in subsequent 3B. So we can very well disclose in K and L. However, as there is a concession given as of now, we can show all those supplies net of B2B supplies or net of exports or deemed exports in table 4B2, 4E itself, rather than showing separately debit notes and credit notes. So this benefit is exemption or concession is still there in 2021. Thereafter, table 5. Table 5 is basically, I can't say key on which no tax is payable at all. So ideally, those are taxable supplies also, but on which GST is not payable if there is some exemption or export is done or a zero rate supply is done without payment of tax under LUT or what. So those transactions are covered here in zero rated supply 5A. Thereafter, 5B is basically SEZ, supply of goods or services to SEZ without payment of tax. So SEZ, we know it's a special economic zone, which is a demarcated area and treated equivalent to a foreign territory. Therefore, the benefits of exports are generally extended to goods supplied to SEZ, which is ideally within the limits of the definition of India, within the boundaries of India. However, it is still considered as a separate territory and benefits have been granted to those. So thereafter 5C, if I am supplying a service, I am a transporter. Now many transporters have started to go under FCM because they have realized that the huge amount of benefit they are going to get with regard to the ITC. Though there would be some sort of initial 1 year, 2 year glitches for them, but they have accepted that because the cost of a consultant or hiring a tax team or accounts team is comparatively very less than the benefits they are going to receive because they purchase trucks and all on which GST is almost 28%. So that credit they don't want to miss. So people have started going. So a transporter is registered. If he's providing under RCM, then those supplies have to be disclosed here. Thereafter, there's an exempted supply. We know very well what are exempted supplies, and thereafter nil-rated non-GST supply. Now, non-GST supply, friends, there was a amendment in the instruction that non-GST supply would include no supply. Now, what is no supply has not been defined at all. However, they have clarified through press release. I won't say that that was a perfect clarification, but they had clarified that the schedule 3 items, which are neither supply of goods, neither supply of services. Example, there are employer-employee services, basically, those salary we say, that is covered under schedule 3. So what they were trying to say that schedule 3 items would be covered. So they didn't mean to cover the salary component or that supplies. If I'm receiving salary and I'm doing business, so all those are not to be disclosed here. So no supply ideally means basically if I have sold land, so that can be shown in non-GST supply, no supply, because it is neither a supply of goods nor a supply of service, you can say. So there are other items as well. So people have got confused that all incomes, so there are dividend incomes. People have got also confused with regard to the capital gains, the foreign exchange gain loss, all those, whether they would be covered in no supply. So in my view, ideally, we should not mention or we should not cover those under no supply. Those would be separately covered, or it would be a reconciliation item, or it would be a 9C item which would be disclosed in table 5O, any other adjustments. We can do that. So going ahead, similarly, debit note, credit note has to be disclosed separately out here. However, benefit we as of now in 2021 we can show net of supplies. So going ahead, I am jumping directly to table 9 basically. So table 9 is the most important, you can say, because ultimately whatever liability we have disclosed in table 4 is populated or is not populated, but it has to be punched out here in tax payable manually, and thereafter my liability what I have declared in GSTR 9 would be compared with what I have paid through cash or through ITC over the 3B that have been filed for the financial year. So that would be a comparison basically whether you have shown exactly what was reflecting in books in 3B. If yes, this would be matching, the tax payable and the tax paid column would be matching. If not, the tax payable and tax paid would not be matching. So there can be two ways, the possibilities. One is that I have paid excess or I have paid short. So I will be covering those topics separately. So going ahead, the importance of table 10 and table 11 of GSTR 9. Now this has a significant importance because this entries, whatever has been disclosed in table 10 or 11, is impacting the auto-populated data in GSTR 9C. So GSTR 9C, the data which is auto-populated from GSTR 9 is ideally the tax liability which has been disclosed in table 4 plus liability disclosed in table 10 minus liability disclosed in table 11. So what is that is to be disclosed in table 10? So any sales or supplies pertaining to, say, let's say for financial year 2021, which we have missed to report in GSTR 3B of financial year 2021, but have subsequently suo moto disclosed in April 2021's 3B or till September 2021's 3B. Thereafter, those supplies have to be disclosed here in table 10 and 11. So if supply has been disclosed, then it would be coming in table 10. If we have shown excess liability, excess payable, we have paid in excess, and thereafter we have issued a credit note, which was forgot to be disclosed in table in GSTR 3B of financial year 2021 and subsequently shown in financial year 2021-22's 3B, then that can be shown in table 11. So going ahead with this, now this was GSTR 9. Now I would be covering GSTR 9C, the sales part. So GSTR 9C, we know table 5. This is the most important table ideally. So table 5 starts with table 5A. Now if we read table 5A, it says turnover as per audited financial statements. Now there is a confusion with regard to this, or we can say there are divergent views since there's no standard which has been prescribed or to be followed. So people are having divergent views and people are doing it differently. And I won't say that anyone is wrong. Basically, everyone is right as per their understanding. So table 5A turnover. So people are confused whether only the turnover element, that is revenue from operations. We show revenue from operations and then there is other income. So the sales part is shown in trading, and thereafter we have prepared P&L which covers other incomes. So there can be various incomes like dividend, interest, sale of scrap. Also, people show it in other incomes. So all those basically whether those have to be covered in table 5A or not. So this is what I would say. Ki ideally, what they want is all income should come here. So though even though they have used the word turnover, in my view, they want all incomes that have been earned by an assessee during the year ideally should be disclosed here, basically. So whatever is there in the income side, be it the trading, be it the profit and loss, all those have to be clubbed. So the major issue basically comes for those persons who have multi GSTs. So for multi GSTs, they will have to break the audited financial turnover into different branches turnover and thereafter show, because we know that each GST has to file GSTR 9 separately. So they have to break up the turnover and disclose only that part of turnover which is relevant to that state or GST. So there are many incomes which are other incomes, generally dividend, interest. Those are booked at HO. The loan is given by HO, we say that. So ideally, all those other incomes generally form part of the GSTR 9C in the HO's GST. And all other GSTs, which are the states or branches, so all those generally covers only those incomes which are relevant to sale of goods or services. Now we have been facing practical difficulties. Now we know that GST audit from department has also started since almost a year now, and they have been asking for state-wise trial balances. So people actually don't have a system wherein they can get a state-wise trial balance. So whether that is required or not. So basically, from an auditor perspective or from a CA who would be filing GSTR 9 and 9C, who won't be auditing anymore, from his perspective, ideally he should have a breakup of all those states, the aggregate of which should match with the audited financial statements ideally. So that breakup is required, even though there is no mandate requirement that state-wise trial balance has to be prepared by a assessee. So going ahead with this, 5B is unbilled revenue at the beginning of the financial year. So now these are basically, I am going in this because otherwise I feel this form has, there's nothing to explain actually, because all adjustments from 5B to 5N can be directly disclosed in 5O. This leeway has been given for starting from the year since its inception for 17-18 till 2021. So all these fields are optional. However, I believe most of the CAs now have understood the importance of disclosing it in GSTR 9C so that it is easily explainable to the officers at the time of department audit. Because now everyone has received the experience of how department is approaching this GSTR 9 and 9C. So now people have started understanding the importance of disclosing it as and when it is possible to be disclosed. So what is unbilled revenue at the beginning of the financial year? Ideally, there are few industries where revenue is booked as per say accounting standards or Ind AS. However, the point or the trigger or the milestone, let's say in the construction industry, as per percentage completion method, a revenue has been booked for say 10%. But however, as per GST, the milestone was to be achieved at 15%. So a billing has not been raised or bill has not been issued to the customer. because as per the agreement, milestone is ultimately the breakup. The continuous supply of service is basically receiving the consideration in parts and supplying the service in parts. So it's a continuous supply wherein billing would be done in parts. So in construction industry, since it takes over a period of 3 to 5 years generally for a project, so the revenue recognition as per income tax and as per other laws is different. So let's say in construction industry, 1 crore is booked as revenue as per the Ind AS. However, as per GST, there's no turnover because it has not been billed. The trigger, the time of supply has not been risen, so therefore bill has not been issued as of now. So this time gap, ideally, they have anticipated all those time gaps. So this form has been beautifully drafted so that it covers the major differences in a separate table itself. So unbilled revenue has to be disclosed here, has to be added for say financial year 1920. If a revenue was booked in 1920, but its billing was done in 2021, so ideally it won't be in my audited turnover. So the 5A won't be included in that turnover. Therefore, this turnover has to be added so that we reach to the GST turnover for financial year 2021. Similarly, unadjusted advances at the end of the financial year. So basically, advance has been received in 1920, GST has been paid on that, only those advances. Now we know keep officers are also seeing at the advances that have been received in the service industries, and they are cross-checking whether you have paid anything or whether there is any outstanding advances which have not been adjusted during the year, whether it has been disclosed in GSTR 1 or GSTR 9 or 9C, because it is reflecting in balance sheet advances received from customers. We generally make a separate schedule. So as the time is passing, we are understanding the importance, better to disclose it separately rather than disclosing in table 5.0. So with this, I would believe that in financial year 2021, since now there is a lot of time and most of the things have settled, so let's focus on this and let's deliver a better service so that the queries are not raised by the officers. So going forward, deemed supply under Schedule 1. We know Schedule 1, basically branch transfer is the classic example which is covered under Schedule 1. If we give gift, even that can be covered under Schedule 1 supplies. So a donation made of computers which have been purchased, so that is also covered under Schedule 1 supplies. So either we avail the ITC and subsequently show it as a supply, or we don't avail the ITC at the first instance itself. So if we have availed the ITC, ideally it would be covering under deemed supply, and therefore we have supposed to disclose it in deemed supply. So thereafter, credit notes, trade discounts, these are all basically those credit notes or trade discounts on which there's no GST impact. So a credit note has been issued, but it is a non-GST credit note or commercial credit note, wherein there is no GST impact. So at times, the time period for issuing a GST credit note has gone, or it is convenient for my system or me to issue a non-GST credit note rather than going for a small penny amount or petty amount. We don't issue a GST credit note. That can be a stand of the company. So in that case, those have to be disclosed here separately. Now, G is basically turnover from April to June 2017. That was required only in first 17-18. Now it has no relevance basically. Similarly, what has been added in the table 5B and 5C, because that were revenue was booked or GST was paid on advances in 1920 and the billing has been done in 2021. Now, similarly, there can be situation where advances have been received in 2021 or a revenue has been received and booked in 2021. However, billing has not been done in 2021. So that has to be reduced because these are overlapping transactions which would be there in specific industries every year. So both those columns 5B, 5C and 5J and H and I, those would be required to be filled, especially in construction industries, I believe. Thereafter, there are 5K, 5L. Basically, it is supply goods by SEZ to DTA units. They cannot disclose it in GST 1 or something. So therefore, they have to show it separately so that it is derived here to reach the turnover of GSTR 9. So with this, there is another two adjustment. One is under composition scheme. So there are very rare cases wherein a dealer who is registered for a composition scheme for part of the year and thereafter for the balance part of the year he is going into the normal taxpayer. So for that period basically for which a GST or 9(9)(c) is not required to be filled, because for composition taxable person 9(a) is required to be filled generally. So for that period, that adjustment is to be disclosed here. Now, adjustment in turnover under section 15, friends. Now, section 15 is applicable in many cases. I would say in most of the cases, depending on the accounting policy that has been followed. So we say ki whenever there's a sale of good in normal traders, a small trader, MSME, so a bill is raised for 1 lakh. After that, there's some packing, forwarding, or loading, unloading, or transportation charges that is being collected from the customer. And we are collecting GST on that also. And that is as per section 15, ideally. So if the transportation income, unloading income, that is not shown in income, it has been shown in the credit side of the expense itself, because whatever we pay, ultimately we recover. There can be no profit margin, or there can be with a margin. However, we don't recover from every customer, so people show it in the credit side of the expense. So these are all different policies. So based on that, if it is disclosed in the income side, it would be automatically added in table 5A above. So there's no requirement to add it again, basically. However, if it is not disclosed in table 5A because it is a part of the expense side, credit side of expense, then we'll have to add it, and that would be a section 15 adjustment ideally. So that has to be disclosed. Now, up ahead of this is basically turnover due to adjustment in turnover due to forex, foreign exchange gain, or foreign exchange adjustments. Now, I would give you a simple example. So people have started considering this as whatever forex gain and loss they are receiving, that is to be disclosed here. So in my humble opinion, I believe you have to check two things. First is export has to be the foreign exchange. The foreign exchange currency has to be booked as per the valuation rules ideally. So it says that you have to follow the custom rule for deriving the US dollar exchange rate. The exchange rate has to be followed as per the customs. Every fortnight or within 14 days, we can say the rate is generally notified for exchange rate. $1, €1, everything is notified by custom. So ideally, if a person doesn't follow that while accounting, he says that that I had faced this in a MNC company while doing audit. So they generally bill at a standard rate, which is a monthly revised rate given from MNC, which is operated from outside India. So they generally book sales on that. So let's say, for example, they have booked the sale at 98 rupees. Ideally, as per the customs exchange rate, the price should have been 100 rupees. So this is a 2 rupees gap. And thereafter, while receiving from customer after 2 months, 3 months, they've received 104 rupees. So ideally, gain booked in book 104 minus 98, the difference of what has been received and what has been booked. So the 6 rupees is the exchange gain, ideally for an exchange gain. However, what is to be disclosed in table 5N and 5M is 2 rupees in 5M, that is section 15 adjustment, and 4 rupees in 5N. Now, to be honest, if you say what is the importance of this, there's no such importance of this. However, this is what ultimately has been prescribed in this form. So ideally, we should go as per this way. That is the correct way. There won't be any impact on the liability. I totally agree with everyone whosoever is getting thought what is the purpose. However, this is the right way. And any other adjustments which could not be adjusted above can be done in a residual head, that is table 5O. So right now, government has given us a leeway that instead of filling each 5B to 5N, you can fill the whole of the amount in 5O for all the adjustments. Now, people have done that in 17, 18, 18, 19. But now, department is going to, we know, department audit is on, so department is going to ask for the bifurcation of those amount that has been disclosed here. So in the initial, people were like, it is not telling, so difference amount dal diya either. But now you have to answer your difference case cheese ka tha at this phase. So it is better to actually derive the figures at this point rather than to be in a position where we cannot answer or we cannot defend clients in a subsequent stage. So it is better to actually bifurcate each income in my view and show it in separate parts wherever applicable rather than using 5O. Thereafter, it is basically a turnover is derived from 5A at less till what is the annual turnover after above adjustments, and after that turnover is compared with the turnover that is reflected in GSTR 9. So after filing GSTR 9, the turnover will be auto-populated out here. So that would be basically table 4 plus 5 plus 10 minus 11. So that 4 tables of GSTR 9 would be considered while auto-populating the figure here in 5Q. And thereafter, if there is any difference, that has to be explained in table 6, ideally, the reasons for difference. Moving ahead, now this is table 7. So ideally in table 5, what was compared is the turnover, the total turnover, the gross turnover. Now, after that, the government warns us that we remove the turnover on which GST is not payable due to XYZ reasons, and thereafter there has to be a comparison between the taxable turnover as per GST 9C and as per 9. So in 7B, C, D, E, each transaction basically covers those transactions which GST is not payable. So exempted, nil-rated, non-GST supply and no supply turnover has to be disclosed in 7B. So question comes as in dividend income. If it is, I take a view that it is not to be disclosed in table 5A. Okay. Then whether it is required to be disclosed here, I would say it was not required to be disclosed here. Then that thing, ideally, when they call for the audited balance sheet, they see the total turnover as per the financial statement is not matching as per this and as per 9C. So it's better, I believe, to disclose it somewhere at least, so that this differences are easily explainable at the point of time of audit. So after that, 7C is zero rated supplies without payment of tax. As I said, under LUT or bond, you can export. So SEZ supplies are also to be disclosed here in 7C. Above, we have seen in table 4 of GSTR 9 that exports with payment of tax, SEZ with payment of tax are to be shown separately. However, here it is to be clubbed together in table 5 where we show it separately, it is to be clubbed here together. There, the supplies on which GST is payable under RCM by the recipient. So if I am supplying any service, say GTA service or a legal service, being an advocate, so if I do that, then the opposite person has to pay under RCM. So that turnover has to be disclosed here. If I am registered, I need to file it here. Going ahead, if there is any unreconciled turnover, that has to be disclosed in table 8. And this is table 9 basically. The total, this is merely a bifurcation of what has been disclosed in table 7F, basically taxable turnover as per liability declared in annual return or as per adjustment above, the taxable turnover as per adjustments above. So basically 7E is to be bifurcated rate wise into table 9. So 5%, 12%, 18%, all those has to be disclosed out here. So with this, this is the run through, basically a walkthrough. So now question comes, I hope it would be an interacting session. So I would like to ask or basically give you all a 5-second time to think basically after completing 3 years of audit. Now, what is actually the position in your mind, whether while filing the outward supplies part in GST 9 and 9C, whether 3B is to be taken, whether supplies disclosed in GSTR 1 is to be taken, or whether supplies as per books of account is to be considered. So I would request everyone to make it interactive so that I get to know whether people are understanding what I'm trying to explain. So I will be opening the
Participants can unmute themselves and discuss with the speaker.
okay. So there are queries which I'll be taking after in the end, Nilesh ji. So people are saying books and GSTR 1. So I'm happy to see at least different answers. So people are saying books, 3B plus books and 3B. Books and 3B. So major answers are books and 3B. So how do we go ahead, or how do we understand, or how do we interpret books and 3B? So we'll have to break it down. So basically, Sheetal ji is saying ki it is all basically. So thank you for the response, friends. Uh, there is still a bit of confusion, I believe. So this is what I wanted to know from your side, whether everyone feels that it is a settled thing कि भाई 3B लेना है, books लेना है, there's nothing to worry about one. So whether it is settled or not, this is what I wanted to know. So we'll discuss it ahead, whether what you all have to answer after the end of the discussion ideally. So I would be skipping this slide because this is ultimately the answer what I want from you all. So I would be directly jumping on case studies or issues basically. So there are different ways. Basically, there can be different scenarios. Since there are three books or three data that are to be compared. One is GSTR 3B, GSTR 1, books of accounts. So in a very rare scenario or in a very small business, generally all three are matching. At least now in this 1920 period and 2021 period. Initially 17, 18, 19, 19 किसी का भी match नहीं होता था, be it small or big. So that is the worst one scenario. So in that case, whatever is auto-populated, unless and until there is a technical glitch, you need to verify obviously the auto-populated GSTR 9. But after verification, I don't think that there is any amend you need to do, and you can straight away file the GSTR 9. Basically, auto-populated data would be suffice after verification. So second case is 3B and books are matching, but GSTR 1 is not matching. So in my view, basically GSTR 1 has not that of importance, especially since now we are not doing auditing. However, from a customer perspective, it is important. But right now, I'll be sticking from the CS perspective while verifying or while filing GSTR 9 and 9C. So it is not that important. However, in case GSTR 1 is not matching with 3B or books of accounts, there could be two things. Either your customers would be taking follow-ups from you or you would be taking follow-up from them. I hope I could convey what does mean. So either your customers will be taking follow-up that kindly upload my invoice in GSTR1 as it is not reflecting 2A, or they will hold your payment and you will take a follow-up from them, kindly release the payment. So it could be any of the scenarios ideally. With the experience we have started to gain from department audits, now we have seen that GSTR1, which we were not considering of that utmost importance while doing auditing of 17, 18, 18, 19, 19, 20. And many people have not verified GSTR 1 in 17, 18, 19. But now they have received a notice from the department that your turnover as per GSTR 1 is showing X amount. Say example for 1 crore. However, your sales as per 3B or books is showing 90 lakh only. So kindly pay directly. They ask to show cause. Kindly pay the GST on the difference amount of 10 lakh or explain the reasons. So we never thought this can be a scenario. Ideally, GST one में ज़्यादा जाता नहीं है. But in the initial period, everyone, including us also, we were all new to this compliance, and we were finding it very difficult to catch a hold of those in the initial months at least. So we have made errors. So sometimes errors are made by us, sometimes error by the accounts team. However, this is now of utmost importance, at least while filing financial year 2021, I believe. So ideally, you should reconcile. However, while filling GSTR 9 and 9C, I don't think so. It has any significance whether a particular transaction has been shown in GSTR 1 or not shown. So in my view, you can ignore that GSTR 1 while filing GSTR 9 9C. So third is basically 3B1 in books of accounts. All are not matching. So that has happened in the initial year for me also in one of my clients. So that is basically an ICU case, I call it. So in that case, you have to first determine which is the final. Ideally, we say the audited financials are final. But no, we have come across situations wherein the audited financial statements are showing X turnover, but as per the GST turnover, as per the records, after authentication verification from the accounts team, they are agreeing that the turnover what has been shown in audited is not proper, and this is the proper books of accounts. So therefore, books of accounts, I'm not saying audited financial statement out here. So all those three are different. So next is fourth possibility is 3B is not matching with one or books of accounts. One and books of account are matching. So my customers are not going to harass me because ideally I have disclosed everything. And whatever is sales as per books, that has been shown in GCR 1. However, in 3B, I have either shown excess or even shown less. So now I have added this a little worrisome for customers if sales as per 3B is less than GSTR 1. Now books say the turnover is 10 crore. GSTR 1 say the turnover is 10 crore. However, 3B says that turnover is only 8 crore. Then we know nowadays in this COVID scenario, we have come across some situations there the officers have visited the site. There was no one at that point of time due to COVID restrictions, and they have presumed them to be a fraud person, and when they compare the liability of 3B and 1 or books, basically they have paid less amount or they have paid no amount in rare cases. So ideally this can be a scenario wherein we as a customer have to be worried, or we as basically the advisor of a client, we have to ensure that 3B1 is ideally matching. So that is the importance of 1. Otherwise this could be a scenario wherein you will definitely receive a notice. If in case the amount in 3B is disclosed is less compared to 1. So thereafter the fifth possibility is 3B and 1 is matching. Ideally books of account is not matching. So at the time of audit or at the time of verification, we have come across few transactions wherein GST was payable, however it was parked in some other GL. Therefore the accounts team could not understand, and accordingly GST has not been paid on them. So ideally 3B and 1, they are mapping it, they have been trained properly by us, and they are filing it properly. However, the books of accounts at the time of verification at the end of the year, we have come across that the turnover is not matching with 3B and 1. So this is a common case, ideally, I would say. So after this discussion, I am directly taking you to the case studies. So there can be ideally possibility two scenarios. One is I have paid excess tax in 3B of financial year 2021, or I have paid less tax in financial year 2021. So in this possible scenario, possible situations, there are different scenarios or different possibilities which we can trace it out after going deep diving into it. So if we have excess paid in as per 3B of financial 2021, there's a possibility that we have realized it, and we have subsequently in April 21 to September 21's 3B, we have reduced the liability to that extent. We can do that as per the circular issued by CBIC. We can adjust in subsequent month. There's no concept of revised and all of that. Scenario 2 is basically tax has been short paid in 1920. So in 1920, I had paid only 90 rupees instead of 100. So now that 10 rupees I have paid in the while filing 3B of 2021. However, my sales as per books is 100. So ideally, I have paid to 3B of 2021 110 rupees. However, sales as per books is 100 only in this year. So this could be a second scenario. And third can be tax is actually paid in excess. There are at times that we have paid in excess. We have cancelled the invoice or something, the client has cancelled the invoice, sorry. So in that case, the excess tax has been paid. So in that case, we have to ultimately go for a refund. So these are different scenarios. So I have taken the screenshots of the workings made in Excel for a better understanding for you all. So basically, this is the scenario 1. So what has been, how to disclose that if it has been adjusted in subsequent period. So ideally, in my view, 110 is to be disclosed in table 4B, because that has been paid through 3B. Ideally, we can see table 4B, 110 has been disclosed. Thereafter, in table 9, tax payable and paid through cash is matching. And in table 11, I have subsequently adjusted in 3B. So I would disclose 10. That is minus 10 for your understanding. Ideally, it is 10. So what will be auto-populated in 9C is 110 minus 10. That is 100 in 9C. And audit sales as per audited financial statement would also be 100. So ideally, there won't be a scenario wherein this is going to be covered. But there is a different scenario, a different possibility if this is the case. So if tax in 1920 has been paid short, so I have paid 10 rupees of 1920 in 2021. So in that case, how do we disclose it? We disclose it in table 4B, 100 rupees. Table 4B में दिखाने के बाद there would be variance basically. The tax payable and the tax paid would not be matching ideally. There would be 100 rupees and 110. So it is, you can see, you can visualize from this that 10 rupees has been paid in excess in this case. However, it is actually not paid in excess ideally. So this is the scenario wherein a reconciliation would be there, a difference would be highlighted. So in 9C, what will be auto-populated is 100 rupees. So my sales as per books is also 100, auto-populated from 9 is also 100. So there would be no mismatch. So in this case, we can put a note. However, since 2021 is no more audit is required, they have removed the part of the observation, which was otherwise required as a part of certification. So now this 10 rupees, which we were generally putting a note that the difference in tax bill and tax paid in GSTR table 9 of 9 was on account of so and so reason. Now there is no such option ideally. So what to be done in this case is a thing we need to consider. So in that case, shall we show 110 out here so that 3B is matching, and thereafter a difference is coming in 9C, and we mention in the unreconciled turnover after table 5 there is reason for the differences. We can mention out there that this is the reason. Ideally it would be highlighting in table 9 the rate wise liability, because this is basically tax component and not the turnover. But I'm just trying to explain you. Ideally you can do this and be mum. They won't be raising query because you have paid in excess as such as per financial year 2021. However, in case they come, you can explain that it was pertaining to 1920, so then they would demand interest. If we show it in unreconciled turnover in 9C, that would be a better position in my view, so that the difference is highlighted to them, so that they don't issue us a notice to ask about this thing. Third is we have actually paid short liability. We have actually paid excess liability. So liability as per table 4 books is 100. What has been payable, what is payable is 100. What has been paid through cash is 110. So it is not only paid through cash, it is paid through ITC as well. However, for convenience purpose, I have just taken that part of the screenshot so that it becomes easy for me to explain you all. So in this case, it is excess, and thereafter it has also been clarified through press release that we have to file a refund application, which otherwise also not required a press release clarification. We know that. So before jumping to the second possibility, I would just take you all to that what is my stand, what is my view basically. So what is to be disclosed in outward supply in my view is step one, you should always take turnover income as per books of accounts. Now, as per books of accounts to bol diya, but how do we disclose? So step one is we have to take the turnover or income as per books of accounts. The disclosure part in GSTR 9 is to be taken as per what how you have disclosed in 3B. So in my view, always take books of account as base. Thereafter, you verify the 3B whether that turnover or liability of the income disclosed during the year has been paid to 3B of financial year 2021 or has been paid subsequently from April 21 to September 21's 3B. So step 2 is decide whether the supply sales income would be disclosed in table 4 of GSTR 9 or 10 of GSTR 9 considering 3B as base. So to determine whether it will be forming part of table 4 or table 10, that would be based on how you have disclosed in 3B. But ideally, a sum of table 4 plus 10 should match in 99% of the scenarios what I could envisage. So therefore, I say ideally base is to be taken always the books of accounts, and disclosure has to be done as per 3B. So in this case, you can see there's no importance of GSTR 1 ideally. So if disclosed in GSTR 3B, I have made a flowchart for this for easy understanding. So if it has been disclosed in 3B of financial 2021, disclose it in table 4. If it is disclosed in 3B of April 21 to September 21, disclose it in table 10 or 11. There could be a scenario where a credit note has been not considered in the 3B of 2021 and has been disclosed in subsequently. So the liability of subsequent has been reduced to that extent. So in that case, you have to disclose it in table 11. So if not disclosed in 3B of 2021, there could be a scenario where at the time of verification of books of account, I have come across a transaction wherein I could have convinced now, or there was some divergent views. The client was saying no, GST is payable on this, and now I'm saying it was payable, and we have taken an opinion or a verdict has come wherein we have taken a revised stand that GST is payable on that, and we have not paid till the time of GSTR 9 filing of 99C, and the time of April to September 21 has already lapsed in that case. In that case, we can disclose it in table 4. This has also been given clarified through instructions or and press release as well. So even before that, this is how we used to do at our old firm. We used to disclose whatever is payable in table 4, and the difference ultimately whatever was coming in tax payable and tax paid ultimately was paid through DRC 03. So this is my view basically. Since I feel there would be a shortage of time, I'm not asking you all as in or not inviting views from you all. I feel I need to run through a few possibilities in a haphazard manner now. So going ahead, we were here in possibility 2. So there could be a second possibility that the tax paid as per 3B of financial year 2021 is less, short tax paid, compared to the liability as per books. So if that is the scenario, what are the different, if that is the situation, what are the different scenarios which we can get after deep diving into it? There can be a possibility that the balance tax has been paid in subsequent years 3B from April 21 to September 21, or it has been a case that excess taxpayer in financial year 2090 has been adjusted in 3B of 2021. So I have paid 110 rupees in 1920. So I have paid 10 rupees in excess. So I've adjusted that in while filing 3B of April 2020. So I've reduced my liability to that extent. So ideally, that 10 rupees has been reduced from total 3B. So the annual 3B says only 90 rupees has been paid, whereas my book say 100 rupees is payable. So this could be a scenario that I have adjusted the excess paid of last year in this year. So in that case, there's no need to worry. Third is, actually I have paid short till date. In that case, I have to pay through DRC 03 ideally if the time for disclosing it in subsequent 3B from April to September is ideally gone. In the present situation, it is already gone. So any findings would be paid through DRC 03. So what is the scenario one? How would it be looking in disclosed in table 4 of 9? So it would be 90 rupees. So basically first is balance tax has been paid in subsequent year. So I would disclose total my turnover as per books is 100. So as I said, step one is always take the turnover as per books. So 100. However, how I have discharged it, I have discharged through 3B of financial year 2021 only 90 rupees. So I have disclosed table, I have disclosed 19 table 4 and the balance 10 rupees in table 10. So the total of this 90 plus 10 would be going in 9C, and there would be no difference ideally when compared to books. Second possibility is excess tax has been paid in 1920 and adjustment has been made in 2021. In that case, we can disclose 100 rupees in table 4, and there would be a difference in table 9, the tax payable as per 9 and tax paid as per 9. There would be a difference. Now this was ideally, we used to put it in observation that the difference is on account of liability of 1920 that has been reduced in 2021. However, liability has been properly discharged for 2021. However, since there is no such place for putting our remarks or observation, or we can, in spite of there being no difference, we take a call that ये point highlight कर देते हैं, भले difference नहीं है. Then I don't think so that is the right way. So ideally, either you create a difference and then highlight it, or you wait for officer wherein you can explain this situation. This is the scenario, sir, and this is the reason. Therefore, I have not violated any law. Scenario 3 is tax is actually short paid till date. In that case, we are supposed to discharge it. We are supposed to disclose 100 rupees. Tax payable would be 100 and paid through cash is 90. So the difference of 10 rupees is ideally payable through DRC 03 after filing GSTR 9. We can do that. Now, this was simple transaction basically so that we be on the same page. Everyone has already gone through this. However, I was explaining you all because people still have a divergent views in this. So therefore, I was highlighting this. Now, there can be a combination of adjustments. We are say overlapping transactions. So the examples are very simple actually. So there can be a scenario that we have to actually verify the books of 3 years while doing filing GSTR 9 of 2021. So we'll have to keep the adjustments or reconciliation items of financial 1920 in front of us. Thereafter 2021 books and 21-22 books as well to actually do GSTR 9 or file GSTR 9 properly. So there can be a scenario where the turnover as per books is matching with turnover as per 3B and 1, and you feel everything is matched, okay, file the return. But there could be a scenario that 20 rupees pertains to last year, 1920's liability, which has been disclosed in 2021, and 20 rupees of 2021 has been disclosed in 21-22. Ideally, this is, we used to say this compensating errors, jo bolte the. So ideally, this is a sort of such situation. So where it is possible. So just don't go with a picture that if everything is proper on the face, that doesn't mean there's any reconciliation item. There could be. This is a rare scenario, but there could be. So there are few divergent views, I believe. So I hope everyone agrees that interest on fixed deposit. Many people have a view that the fixed deposit for a company especially, or for a proprietor firm, fixed deposit रहता है for excess funds, and an interest is earned. Ideally, that is not part of a business. That is not in the course or furtherance of business. So many people don't take a stand that this income may not be disclosed in GST 9 or 9C, because this is not in the course of furtherance of business. Or ideally, if you have taken that now, since non-GST supply includes no supply, we disclose it there, or we show it in exempt supply. Now, ideally, interest income has been exempted by the exemption notification. So either you disclose it in exempt supply or non-GST. As of now, there's a leeway where we can disclose exempt supplies, non-GST supplies, all under exempt supplies. Our people who file it properly, they go particularly interest it has to be disclosed in exempt supply. Now in 17, 18, 18, 19, even I did the same thing. But now I have realized that officers are started issuing notice that you have disclosed exempt supply, but you have not reversed any ITC. How is it possible? So I have to explain them that from 22nd January 2018, there's an explanation that has been added in Rule 40 to 43, which says that no reversal is required on interest income, which is exempt income. So ideally, this income is still an exempt. However, no reversal is required. Therefore, we are not reversing it. So I feel lawfully you should disclose this in exempt supply, and whenever the notice comes, you can explain them the reason. However, if you want to don't take the headache of explaining to the officers, you might simply show it in non-GST supply, or you might not show it. You might show it in 9C as a RECO item. You can also do that way. In case you don't show it in 5A or 5O, it would be a RECO item. So going ahead, dividend income is one more income which is received nowadays. In COVID, everyone has started investing in securities. So there are gains as well as dividend income. So dividend income जो भी receive हुआ है, whether GST is payable on that or not, so ideally it is not payable. So whether this has to be included in no supply. So few people say that the no supply, the purpose of getting no supply is ideally to cover all those incomes which are generally not covered in purview of GST. So we consider non-GST supply are those on which GST is not leviable. And now they have expanded the scope by mentioning non-GST supply includes no supply. So people feel that this is the reason for all those incomes they have got this. So people have started disclosing this in table 5 ideally while filing GST 9. So this is also proper, and otherwise you can show it in directly GST 9C, a RECO item, or in any other adjustments, provided you show all those dividend incomes as well in table 5A. If you show it in table 5A, you will have to ideally reduce it in table 5O or any other adjustments, so that the turnover derived from GST matches with this thing. In case you don't want that, you can keep it as it is, show it in 5A, and thereafter don't disclose it anywhere. Auto-populated data will come, and there would be a difference ideally, and that could be explained that this is on account of dividend income. So these are all different possibilities I have shown. Table 5A plus O, table 5A, and unreconciled balance. Now, what is to be included in table 5A, I have already discussed. So people still take a stand that in major companies, we generally show only revenue from operations and all other incomes are not shown in all. But I believe what is their purpose is ideally to disclose the whole of the incomes that has been disclosed in audited financial statements. And thereafter, we have already bifurcated most of the supplies or transactions either into taxable supplies or non-taxable supplies. So there would be very rare cases wherein there would be incomes which are not there in disclosed in 9. So this is one of the. Now we know high C sale, bonded warehouse sale. So this were ideally there were ambiguity whether GST is payable or not and all. However, they have clarified subsequently by amendment in Schedule 3 that this transaction will be covered in Schedule 3. So ideally, these are neither supply of goods nor supply of service. So table 5F of GSTR 9 or unreconciled item in 9C can be shown in this case. So non-GST supply specifically through press list, they have clarified that it includes Schedule 3 transactions. So I believe table 5F is the perfect place for this transactions. However, in case people have different view, they might also keep it as any other adjustments in table 5.0 or keep it unreconciled and show it, because we generally don't show it in GSTR 3B or 1. There's no place ideally, I believe, in my view, to disclose such transactions in 3B or 1. So therefore, we don't show it. So we can still, in spite of not showing in 3B and 1, we can still show it in GSTR 9. And if we don't want to show it, you can straight away take it to 9C. So this was the sales part ideally. Now we are running through the ITC part. ITC, there's one major issue. I don't want to miss on the discussion part from the participants for all the queries, because this is more of a practical subject. So I would like that I would try to finish it up in 15 minutes, and thereafter we can take queries. In case 2 minutes here and there, I will finish the topic, or else I'll take only important topics. So inward supplies now. So the most important question is what approach. Now in sales, as I've said, ideally step one is take the sales or turnover or income as per the books and decide whether to be disclosed in table 4 or 9 based on table 4 or table 10, 11 based on where you have disclosed in GSTR 3B. Now in ITC, what is the stand? Ideally, this is the most confusing part, and this is actually still happening today also. Today also people are confused which part is right. Ideally, we should take only ITC as per 3B while filing GSTR 9, or we should take ITC as per books of accounts. I would just request everyone to respond with this as in what stand you all are taking, so that I get a brief idea of whether my understanding is right or not. So Sheetal is saying always issue in ITC of mismatch. I totally agree. I totally agree. So 3B and 2A. 2A is ideally different thing altogether. So I would not mix 2A into this, sir. So ideally there are 3B, 3B. So कोई भी ऐसा नहीं बोल रहा है. There is ITC as per book. So ideally everyone is saying ITC as per 3B. Now I would throw light on few things and let you all decide, or let you all rethink whether the decision is right or wrong. At least as per the instructions or requirements from a department perspective, what has been stated. What is practically and logical is something different, but what has been asked to follow is different. So we will be discussing this at large, because this is important. I will be taking this at a stretch. So now ITC as per 3B or ITC as per books of accounts, I am keeping this unanswered, and I'll see after our discussion what is the conclusion. So the moot question comes, if books of accounts, so what is the books of accounts? What is the books of accounts ideally? Ideally, we know कि books of accounts in simple form tally का data है या SAP का data है या all other जो physical registers and all those are books of accounts and all. So ITC as per books what we are supposed to take ideally. So books means in sales what we have done is we have taken sales as per audited financial statements. Thereafter we decide, we analyze each transaction whether this is taxable or not. If taxable, whether GST has been paid or not. Ideally, we do it like this. But in case of ITC, do we run through the purchases, the value of the purchases or something? We don't do that. So ideally, whatever is reflecting in tax GLs, or in simple words, the input tax credit ledgers, ideally that is considered as books. This is a different approach than what has been taken in sales. In sales, we don't say that duties and taxes ka ledger, and we don't see output, CGST, output, SGST, and tally with that. That is not the actual liability. We actually verify what is the actual liability. There can be variance as per the client. He was not supposed to pay GST on that, so he has not posted it, and therefore there was no impact on output CGST ledger or SGST ledger. So in that case, we disclose it in table 4 and ask our client to pay it through DRC 03. So ideally, we don't do a reconciliation, or we don't take the tax GLs as tax liability GLs as base while filing GST 9. However, in my view, while filing GST 9, the ITC perspective, we have to give importance to the ITC GLs, the tax GLs, input CGST, input SGST, input IGST, those GLs, the tax ledgers, that is to be given utmost importance. And the sum of that is ideally ITC as per books, which has to be reflected in 12A of GSTR 9C. I hope everyone is getting at least what I'm saying. Though we might be on different view, we can discuss this. But ideally, this is what I feel. So, what is books of accounts? Ideally, ITC base is ideally ITC as per tax GLs that is to be taken. It can be right, it can be wrong. So we have to prepare a RICO, and that RICO would form part of ideally 9C unreconciled items, in my view. That has to be highlighted. So I would share a few practical examples in the later part. So what has been generally followed while filing 9 and 9C of financial year 17, 18 and 18, 19? Now this is a question basically, ki ITC 17, 18 and 18, 19, we have followed ITC as per 3B. I myself am saying ki I have taken 3B as a base. So whatever is auto-populated in 3B, whatever is auto-populated through 3B in table 6A, that is taken as base, and thereafter I bifurcate that into input service capital goods, or not local purchases, import of goods, import of service, or RCM services. It's a mere disclosure, a sum of would with tally with the ITC that has been auto-populated through 3B. Ideally, that is what we have been doing. But going forward, till that time, I believe there was no specific instruction. So we were following this, and we find it more logical, practical, and more explainable, easily explainable to the officers. So that was the thing, and we actually felt it was right. And this is, I believe, still right. But however, I would just make a run through one important instruction that has come during the COVID phase. That amendment has come. That instruction is basically table 2A. If you have run through the forms, table 2A, this is the important instruction, number 2A, inserted from 15/10/2020. By that time, we have already finished 17, 18 ka GST 990, and most of the cases 18, 19 ka 990 was also over. This was a proper in the middle of the COVID, so might be few people I might have missed it. So I thought of highlighting this. So I'm reading it for you all. In the table, again serial number 4, 5, 6, and 7. Now in the table, as in the table 4, 5, 6, 7 of GSTR 9. This is the instruction of GSTR 9. The taxpayers shall report the values pertaining to the financial year only. The value pertaining to the preceding financial year shall not be reported here. So they have clarified this, we can say, through updating the instructions to GSTR 9. They have what they want ultimately, or how did they frame? They envisaged that everyone would be following this thing, but they were not. They got the experience after doing department audit 17, 18, 18, 19, and therefore they have amended this and clarified this in a sort of way, we can say that for subsequent periods, ideally we should follow this as per them at least. So this is what now I would take you through case studies, as in what I have been following and what I still feel is right and why it is right. I would be highlighting those things also. So ideally, inward supplies purchases, what would be covered in financial year 2021? The ITC availed in 2021 would consist of either ITC of 1920 that has been availed in 2021. There can be two scenarios: ITC of 1920 that has been accounted in 1920 and availed in 2021, or accounted in 2021 and availed in 2021. So this is a possible scenario, because what happens is that many times the invoices come after 2 months or 3 months, or we might miss it. The accounting part, people generally miss it. They quick invoice rag or something. So the books have been closed by that time, especially in corporate companies. So the books have been closed in a month or 2 months. So after that they cannot. So this has been accounted also in 2021 as a prior period item, or I actually don't know how do they disclose it in books of accounts. I am not that good at audit. So if that is the case, then what is the possibility how it is to be disclosed? I have taken both examples. So, and third would be invoices dated 2021 that would be availed in 2021, and that would be a possibility scenario that ITC has been reclaimed. ITC of 1920, 1819 or 1718. I have not paid within 180 days. So as per rule 37, I was supposed to reverse it. Now I have paid it after the dispute has been settled after 2 to 3 years. Now I'm reclaiming it. How do we disclose that? So this there is a possibility that that is also been taken in 3B. So ideally, in ideal scenario, 3B would consist of all these ITCs. So this is a table 6 of GSTR 9 ITC availed. So table 6A is basically ITC as per 3B, which will be auto-populated out here. And 6B, C, D. 6B is normal, we can say B2B supplies, which will receive local supplies other than RCM and import. Thereafter, RCM supplies is to be disclosed in 6 CMD. Now we know that input capital good input service, this bifurcation was a problem for us in the initial year. So 17, 18, 19, 19, they gave us a relaxation that we can disclose everything in inputs. Thereafter in 1920, they gave a relaxation that you have to show capital goods because ideally that is available as fixed assets in major most of the cases. So you show the disclosure of capital goods, and if you are unable to trace it for input service, you can show the whole of the amount in inputs rather than bifurcating in input service. This same thing has been a principle has been followed in 2021. There's no change in that aspect. So we will be following those same aspect in 2021 as well. There's no change of whatever stand we had, whatever rules were prescribed in 1920. Those same have been followed in 2021. So all those fields are optional that were optional in 1920 have continued to be optional in 2021 as well. So after that 6E import of goods, we have to bifurcate into inputs and capital goods. If in case we have imported capital machinery, import of services is basically we know we pay under RCM, and thereafter there are three parts: 6B, 6C, 6D, and 6F. Ideally, where RCM ITC would be disclosed. So 100 rupees is being auto-populated in the given example, and the bifurcation of those 100 rupees is ideally given in 6B to H. A subtotal is given in 6I. Thereafter, a difference between 6A and 6I is given in J. So ideally, this should be zero. Ideally, this should be zero. But there are possibilities that these are not zero based on different stands that have been followed by different persons based on different advices and other reasons as well. So after this table 6, I am not taking on table 7, the reversal part that will be covered later. This is table 8 ideally. So we know 8A and 8B. 8A is auto-populated as per the 2A. Now we have always seen that whatever is auto-populated in 2A and whatever we download 2A, there is a difference generally. Now that reason they have already given that you have to fetch this 2A, what is being auto-populated in table 8A, the data is fetched of 2A arrived on a specific date. So all due dates were given for 17, 18, 18, 19, 19, 20. That table 8 figures have been picked as per the 2A as on so and so date. So this was the thing. So later after that, if someone has taken the benefit of the amnesty scheme or the late fees, they have paid the reduced late fee and filed the return subsequently. Those would be updated in GSTR 2A ideally. However, those won't be uploaded in table 8A if the deadline or the due date by which it was supposed to file has crossed already. So this is a major concern where we have been reconciling this practically, we know that. So after that 8B is auto-populated from what we have filled in 6B and 6H. 6H, friends, I missed it. So 6H is basically ITC that is reclaimed under the provision of this act. So there can be different scenarios wherein I had reversed the ITC. I thought it was not eligible or something, so I availed it and reversed it, and thereafter I reclaimed it. So ideally, all the reclaims would be coming in 6H. So they have even clarified the press list that 6B and 6H, you have to fill either of this thing. You cannot repeat 100 rupees that has been availed in 2021 in 6B on inputs. Thereafter, you have considered this as reversal since you're not paid in 180 days. Thereafter, you have paid it during the financial year itself and reclaimed the ITC. So you need not disclose 100 in 6B, 100 in 6H, and 100 in reversal in table 7. So ideally the scenario would be telling 200 in ITC and 100 would be reversal. Net ITC availed is 100. I totally agree. But ideally if you show it in 6B, 6H, this would be a problem. Table 8B. It would add both those things, 6B and 6H. So auto-populated as per 2A. Suppose it turns out to be say 1 lakh rupees. But since you have since it is auto-populated, the ITC auto-populated would be 1 lakh 20 in 8B. Now, this would give an impression that you have availed excess ITC as compared to 2A, which we know what would result into a notice, an unnecessary notice, which we'll have to explain it. So this is the sin. And thereafter, any ITC pertaining to the current year, which has been accounted in the current year and has been availed in subsequent year between April to September 21, can be disclosed in table 8. So this is then, and after this 8E, F, G, those are all optional fields and are not those important. So I'm taking you to an example, case 1, ITC on invoices of 1920. ITC on invoices of 19, that is invoice dated 1920. accounted in 1920 and availed in 2021's 3B ideally. So what would be auto-populated in 2021's table 6A of GSTR 9? 110 rupees. So 100 is the ITC as per books of financial year 2021. 10 rupees pertains to 1920's ITC that has been availed in 2021. So auto-populated figure will be 110. There are two possibilities. Basically, option one, I have mentioned this as option one here. You can disclose it in this way or disclose in other way. Both are right in my view. So 100 will be disclosed in table 6B. There would be a difference in table 6J, which if you don't want to keep, so you can show 110 in 6B, because in either case, as we have taken a stand till now, that ITC as per 3B has to be disclosed here and not as per books. So books can be, instead of 100, it might be a 500, but we have to follow 3B. As of now, we will go as per this logic. So thereafter, there is an option of 6M, any other ITC available but not specified, or we can disclose it here, because what is auto-populated in 9C is table 6O minus reversal in table 7. The net effect of that is gone, not the effect of table 6I. So ideally 100 is shown above and 10 is shown, so 110 is appearing. That would be auto-populated in table 12C, 12A. So this is option 2. As I have said, 110 can be disclosed here. There would be no difference. In both the cases, how would 9C look ideally? ITC availed as per books is 100, 12A. ITC of earlier year, that is 1920, that has been availed in 2021. We would add it here, 10 rupees, and thereafter there would be no difference, unreconciled. Ideally, 12B and 12C has been given in 9C for this adjustment, which is going to be in every case, in most of the cases, this is going to be there. So they have given this instead of keeping it unreconciled ITC and thereafter you explaining ki this was pertaining to last year, I availed it now. They have given you an option that you fill this table and highlight this, that this was pertaining to this year. Actually, there is no difference for the present year. So this is what you 9C would look like in both the cases, both the option 1 and option 2, because we are disclosing 100 and 110 in 3B, following the 3B method. Second case study is, what if we disclose second is ITC on invoice of 1920 accounted in 2021. So invoice is dated 1920, but my books were finalized. I cannot go and pass the backdated entry. I have accounted the invoice that is received subsequently. I have accounted also in 2021. It has not hit my ITC ledger ideally. It has not hit my ITC ledger of 1920. So accounted in 21, availed in 2021. So 110 would be reflected here. So the scenario would be same of GSTR 9. I have not taken the screenshot of GSTR 9 because it would be same scenario. 110 would be reflecting ideally. And what if you follow? What would be the difference in 9C? I am showing that thing. 100 rupees is being shown as per ITC as per books. ITC booked in earlier financial year, claimed in. This is the one thing what we have done in this thing. Case 1, where invoice was also dated 1920 and accounted also in 1920. Now, if it is invoice is dated 1920 but accounted in 2021, then table 12A figure, friends, kindly note this difference, what I'm trying to explain. As I have said that we have to take ITC as per the ITC ledgers, a combination of input CGST, SGST. So the invoice has been booked in 2021, therefore ITC as per books is 110, and therefore there is no difference only altogether. And I have shown it in 3B also 110 only. So there is no difference. So this is the second scenario. Disclosure in GST 9, same two options as mentioned in case 1. Now case 3, ITC on invoice of 1920, accounted in 1920 and availed in 2021. Now if we follow the ITC as per books logic, we have taken a stand that we have to go as per ITC as per books, and that is to be disclosed in GST 9. So this is one scenario. Therein 1920 ka ITC has been availed in 2021. Therefore, this is 110 in 3B, which is auto-populated. If I take ITC as per books, that is 100. So this minus 10 will be reflected here. Now this 100, table 6O, which is reflecting, this would be auto-populated and gone in table 12D, 12E, sorry. So 100 is as per books. ITC booked in earlier, claimed in this year 110, and ITC claimed in GST 9 is 100. because we would be showing that 10 rupees in 12B for sure. That is a reco item only. So we would be showing ITC as per books 100, 10 rupees has been added, 110 is the ITC available as per books. However, I have availed only 100 rupees. So this is the unreconciled ITC. It shows a picture that I have not availed the ITC of 10 rupees. That is lapsed. We can say that also. Even that can be interpreted. So ideally, this is not proper in my view. So therefore, I believe that ITC as per 3B is the right approach what one should follow. Now, people say that if we follow ITC as per 3B approach, what is shown in table 6B, for example, if we take this example, what is taken in 6B is auto-populated in table 8B. So people are saying कि अगर मैं 1920 का ITC I have availed in 2021, I have availed it, and if I show it here, this 6B would be auto-populated in table 8B. ITC as per 2A is perfectly matching as per my ITC ledger. Whatever invoices I have taken a follow-up, and all invoices what I have booked is ideally matching in 2A, or I have availed only those credits which are reflecting 2A. So there will be no mismatch. But in this scenario, there will be a mismatch because I have disclosed it in 2B. So I agree, this is one of the major reason that people have got confused. Either they want to keep a difference in table 6J, or they want to keep a difference in table 8A. Now, based on the experiences, people have noticed that even if there is a difference in table, a minor difference of in table 8A, that is 2A reconciliation, even though which was optional in 17, 18, 18, 19, we could have manually prepared and scanned and uploaded it, which is not there in 19, 20, 21. We are receiving notices to pay the difference in GST 2A. So it's better you take a stand as per the quantification in this aspect. Ideally, one scenario which I would be explaining you all is how to tackle this scenario in one case. So case 3 we have discussed. This would be the disclosure. Now this was instruction number 2A, wherein initially in 17, 18, 19, we were sure that ITC as per 3B is to be taken. But now, after this, even there is a confusion that whether in 1920 or 2021, we have to follow this strictly, because this is what has been instructed in table GSTR 9 instruction. So we have to show only that ITC as per books, which is there as per books, rather than ITC as per 3B. So therefore, both the approaches are right. Ideally, if we don't want any harassment or we don't want any queries from department per se, so we will follow this only. But ideally, even in this scenario, there would be differences for which you would be getting a query. I'm sure for that. So it's not that we follow this and we are safe now. It's not that. So you have to take a decision case to case. Ideally, I believe ITCS for 3B is the best way because it is logical. And why it is logical, I would say, in my view, always consider ITC availed in 3B as base. It is more logical as it gives meaning to 12B and 12C. Friends, if we have seen the example of this case 3, where ideally 12B and C becomes redundant. If we say the purpose of 12B and 12C is ideally to not give unreconciled differences in overlapping transactions at least. However, if we follow ITC as per books method, we will be getting a difference of 10 rupees as explained in this case 3. So ideally, I believe that is not the right way, even though it has been clearly mentioned in the instructions. Going ahead, and it is easily explainable to officer, I believe. So there's another issue, disclosure of reversal of ITC. ITC reversal. Now we see table 7 is also covered in this instruction. Table 7 is ideally ITC that has been reversed. That has to be disclosed in GSTR 9. So if we see, there are different rules through which we do reversal. 37 is 180 days, 39 is ISD pertaining, 42 is common credit on input service, 43 is common credit on capital goods. I'm not going into all this. 17.5, you all know that. So in case if I have reversed any ITC through 3B, it has to be disclosed in table 7. This is what generally people used to follow. Another approach was whatever is reversal as per the auditor or as per the books, he has client has availed ineligible credit. So people used to show actual ITC that is to be reversed, because what happened, the impact of this was shown in GSTR 9C. So ITC availed 100 rupees, 20 is shown in table 720. So total figure in 7J would be 80 rupees. That would be auto-populating in table 9, GSTR 9C. And thereafter ITC as per books is shown 100, 20 has been reversed already in DRC through DRC03. We used to show it this way. So many people used to say ki nahi, this is not the right way. We have to show whatever has been reversed in table uh, in GSTR 3B of the financial year. So now with this, both these approaches are wrong to an extent, because they have clearly said that ITC as per books or pertaining to the financial has to be taken ideally. In the table again, serial number 4567, the taxpayer shall report the values pertaining to the financial year only. So reversal made in 21-22 or reversal of 1920 made in 2021's 3B, whether that is required to be disclosed while filing GST 9 of 2021, this is the most important query that would be arising in cases where there is a reversal to you all. So I'm just highlighting this aspect. Ideally, I believe you have to take as per books only, pertaining to the financial year only. And if there is any short reversal, then you can make it reverse to DRC03. And if you show as per books, ideally there would be a difference if it has been reversed subsequently. That difference can be highlighted in 9C and a reason for difference can be mentioned. So this is one thing. Similarly, 6H, they have clarified that ITC reclaimed, either you have to show it in 6B or 6H. Now there is a scenario, peculiar scenario, 1920, ITC was availed and reversed. Okay, so they have shown it in 6B and table 7. Now it is reclaimed in 2021. So whether it has to be shown in 6B or 6H or not, ideally it is reclaimed, so we should show it or not. If we show it, it goes auto-populated in two-way reconciliation in table 8A, B, C part. So there is ambiguity with regard to that part. Ideally, reclaimed in next year, this has not been clarified to that extent, I believe. So another issue is disclosure of RCM liability. Relevant tables in GSTR 9 is table 4G, wherein we disclose the RCM liability in GSTR 9. Now, it was clarified through a press release that RCM liability of 1718 paid in 1819 or 1920 has to be disclosed in that year. It was clarified. I have given that, yes, clarification through press release. So ideally, the question comes is whether this is applicable for 1920, 2021 and subsequent years. This is a standard press release, or it was specifically for that particular year. Ideally, everyone has been blindly following this and doing it. Any RCM liability pertaining to 1920 has been paid in 2021. So ideally, it is advisable to disclose it in table 4G of 2021 GSTR 9, so that we follow this also, and 3B is also tallied to that extent because we have discharged the liability to 3B. So the tax payable and tax paid also matches. So ideally, this is the perfect way, and we should follow this only. However, this press release was only with regard to 17, 18, 19, 19, I believe. With this, I extend a thank you to the other CP Study Circle for letting me deliberate my thoughts on this favorite topic of GST 9 and 9C, which is still confusing to many. With this, thank you. Sir Rahul, can we take the question answers?
Yes,
Just
Mitesh bhai.
open it. Others, okay. Could you help me with the question answers which I might have missed if I go to the chat box?
Yeah.
I will take the recent ones. You let me know if any query I have missed it. Basically, the purpose is to discuss. One can unmute themselves and ask the query so that it is conveyed to all, and thereafter, whatever is my view, I can give them. Manish bhai, I'm going through your query. Query for speaker, scenario 1, section 16.4 for 1819 return for Feb and March 19 filled in November. Sir, in spite of wasting time in reading and misinterpreting, I would request if you can unmute yourself so that everyone gets the benefit of your query, even they might be facing it. Alright, can you please unmute Manish bhai? I'm not sure. I cannot see whether he's muted, unmuted. Query was Okay, okay. Query for speakers in section 64 for 1819 written for Feb on March 19. Okay, filed in November 19. AO says applying 16 for I would never allow ATC claimed in Feb and March 19 is written filed after 20th. Scenario 2 supplier has filed written late. So I believe this is not actually pertaining to disclosure of GST 9 and 9C. This is ideally to a scenario wherein the persons who have taken the benefit of the late fee amnesty scheme, as we term it as, and those who have filed the returns now, and those are being reflecting in 2A. But we have already availed those ITC. Now officer is raising an issue that those ITC would not be allowed because that has been filed subsequently in the after the due date of GST 1 is gone. So ideally that won't fit under section 16.4. So ideally I don't think this is the right query for me to answer. I would request everyone to raise the query for the current session. Scenario to suppliers filed written late after November 19 for March 19. After whether my ITC for March will be disallowed. I believe that is again the ITC stand. Sir, if you have any disclosure issues with regard to this, do let me know. I would love to resolve this. If ITC difference is within 5%, then 3B. Rahul Bhai specifically told me that don't entertain any queries apart from this. So I am following those. I have to follow so that they can invite me second time. I'll love to solve it on phone with you personally. I don't mind. If ITC difference is within 5%, then 3B, otherwise 2A. This is basically a rule basically of 36 rule 36.4 where we are supposed to follow the availment of ITC. I don't know what is the exact query. Rahul bhai, can you help me, Praveen bhai, with the queries? I actually cannot raise any queries.
I think it will be good if the participant himself mutes and unmutes and
Either there
asks
are
the
no
query.
queries
Yeah.
or either I have not done justice to the topic so that the queries are not raised. There can be two scenarios.
I think you were referring to Sheetal ma'am's query. If ITC difference is within 5%, then 3B, otherwise 2A.
So I am not understanding the is it perspective as in to disclose it in table 8B or something, and this query is pertaining to that. Or this is just I had asked some questions and I guess she had replied with that.
Sheetal, you there? If you can unmute yourself and ask the question.
So Parimay Rahul bhai, ideally what you all are going to do? ITC as per books or ITC as per 3B?
Hello.
Hello.
Yes,
Sheetal.
yes.
Yeah, I was just saying that if we there is difference in 3B and 2A.
Yes.
So we will take the amount of 2A, but restrict it to 5% if 3B is more. Because they anyways they are not going to give it. And later we will have to pay it with along with interest.
So if you could put it in example for everyone, it would be easy for me to address it if in case there's a concern with regard to that disclosure.
Suppose in 3B we have taken 500 rupees and in 2A it is reflecting only 250.
Perfect.
So restricted to 5% because now there is a gap. In 2021 there was 5%. Now they have reduced to nil.
No, but so are you trying to say that in case auto-populated data in as per 2A is 250, and if I add 5%, and let's say example that comes to around 12.5, so 250 plus 12.5, 262.5 if I have availed.
Yeah.
And so therefore there's a difference of 12.5, so they won't be raising a query. Are you trying to say?
Yeah,
that?
so they will be disallowing it, right? If
no, so they would not be disallowing. They will be ultimately asking you the reasons for such things, because there could be a case that in those 250, what is being auto-populated in 2A, if we go as per invoice wise, there could be a scenario that the 20 rupee invoice ITC we have never availed or was ineligible credit. So ideally scenario is 230 is ITC as per 2A, but you have availed 262.5, so the difference increases. So for understanding the reasons, the real reasons behind this difference. Definitely, if there is a minor difference also, they might issue a notice. Disallowing is ideally, I believe, is a litigative matter. Ideally, I believe 105% or beat, even if it is not reflected in two, at least for the prior years, 17, 18, 18, 19, and to that extent, Rule 36 was introduced, we can definitely litigate that. And there's a high chance that we can win also the case. So
Okay.
I don't think so that would be a concern.
Okay. Thank you.
Yes, welcome. So any query, participants can unmute them. They can also raise the query in the chat box. So now one interesting Nilesh ji is that previously we can easily write note for 5 point or any point. Now new form not allowing to write. So that was basically in observations we used to write it basically. So that certification part observations so we used to write it there. Ideally, as a part of reconciliation statement part A, we could never write any observations. Ideally, in the table 6 of GSTR 99C, that is the difference of unreconciled tenor, we could write that time also and now also. So I totally understand कि अभी वो है नहीं that communication could not be possibly made through 9C, a proper communication, even if there is no difference, which we used to make it earlier at the time of audit. Rahul bhai, Parim bhai, in case there are no queries, if you all have any queries, I would love to.
Piyush bhai has posted a query in chat box.
Okay.
ITC of financial year 2021 to be claimed brought forward, say 30th 9/21.
Before say, okay, if it is not written in 2A or 2B, how to resolve? So with regard to disclosure part, ideally, I don't think so there would be any problem. Yes, there would be a difference that would be coming and that we will have to explain it. Ideally, to my mind, for financial year 2021 also, because that mandate by law. So ideally, everyone knows that. I'll just give you a brief. So basically, Rule 36, subsection, sub-rule 4. We have seen many judgments previously also that ultimately a rule gets a power from the statute. So statute is the parent, the act is the parent, and the rules are the subordinate act legislation. So when there's no power to prescribe anything in the act, can a condition prescribed in Rule 36, whether that would be binded on each taxpayer or the department, ideally. So in my view, that is not valid to that extent. And if department says that it was always there, we have notified it there, the power was always there, then why was there a need of inserting a new clause in section 16, subsection 2? Even though I agree that that clause now again doesn't specify, it says 2A ultimately, it has to be populated in 2A, and the rule clarifies it that it has to be auto-populated in 2B. The section doesn't say anything about 2B, to the best I remember. So if there was already power and you have been following properly as per Rule 36, and if you're disallowing me as per that, then why was there a need or a requirement to get this thing? And this has not been brought retrospective. So this is a prospective amendment effective from 1st January 2022. So this is what I would say. You need to litigate this and not give up easily, to the best of my opinion. For any queries, we have seen this because small amounts, petty amounts, the litigation cost is more. So definitely, I agree it is advisable that a client pays it. But again, with that, we have to see the interest part, the penalty part, how much is the quantum. We have to quantify as a whole rather than the tax part. So we have to see, and if it, I believe that this is something new, a new legislation altogether. We don't know how officers are understanding this law yet. So even if the issue is small, as of now, I make it a point that I take that case in hand and I try to litigate them. Even if the amount is resolved, though I don't get the fees for that. So this is my approach, because that would be a learning for us also. We have already have a background or history or experience of litigating for 20 years, 15 years. We know that. But then this is something different only. Now we get experience of tackling this situation with state officers. Now, state officers, they are not well versed with the laws as compared to the central officers. We know that. So it would be a tough task if it is with state officers. So how to tackle this situation, and in that course explaining them, enriching their knowledge. This is what ultimately, because they would be learning from us also. There is already a national institute where CAs go and other experienced speakers go and teach the officers. So this was again a platform where even in your case it is not fruitful, but that knowledge of the officer enriches and it might help you in subsequent cases at least. ये छोटा है जान दो चलो इस बार, but आगे I have understood, I am with you, आगे से नहीं करेंगे, because we know कि we have a area of officers where we will be working, because we have a fixed area of land, and nodal officer is assigned as per the pin code ideally. So it's not that it's a one-on case or something. We are going to do liaising with officers regularly. I hope I could address the
I
query.
think yes, great addition to what Mitesh bhai said. It will add to our knowledge perspective, which is also very important in our practicing days for GST. So any queries, or we can, I think we are good to conclude. Mitesh bhai, thank you for accepting our invitation.
Pleasure is all mine, sir.
It's the first pleasure is ours to have you on our platform for this lively topic for which due date is being approached. Issues in GST annual returns, which is always a hot topic. GST has always been a hot topic since last 3 years or 4 years rather, since it has been launched. On behalf of the Dadarist CPA Study Circle and behalf of all the participants, we propose a well-deserved vote of thanks to you. Once again, thank you. We would definitely have you in future. Thank you for accepting our invitation. Thanks.
Thank you for inviting me. Thank you everyone for patiently listening.